prior to being hailed as a miraculous economic reform, before its doors opened to the world, and before witnessing a remarkable surge in economic and quality of life indicators, China grappled with a severe housing crisis. The situation was particularly dire in urban China, where space was incredibly scarce. To put it into perspective, the average size of a one-bedroom apartment in Manhattan or an average American kitchen was comparable to the average living space per capita in urban China back in 1980. It wasn't until 1985 that it surpassed the 10-meter mark, and it took until the mid-1990s to exceed 15 meters. When compared to other urban areas worldwide in 1992, only Tokyo, New Delhi, and Cairo had similar average living spaces as urban China. However, quantifying the housing crisis solely based on available space is limited. Urban China faced not only cramped conditions but also unhygienic, unsafe, and antiquated living environments. In 1985, 90% of urban households lacked piped gas, 70% had no exclusive access to toilets, and almost 40% relied on shared kitchens and water taps. China's housing problem was partly attributed to rapid demographic changes, corruption, and widespread poverty. However, at its core, there was simply no strong incentive for construction. During the 1980s, the state bore the responsibility for housing. Housing was either managed by local government housing administrations or provided by state-owned enterprises. Regardless of the source, it was affordable. Rent costs accounted for only 1 to 3% of average income and were not tied to construction or maintenance expenses. While this approach had ideological coherence, it hindered additional housing construction as it did not generate significant revenue like infrastructure or heavy industries. With the state obligated yet uninterested, and private development strictly prohibited, the state of housing in China deteriorated rapidly. Then, Deng Xiaoping emerged, bringing along a real estate revolution. The remarkable development boom in China began with a simple addition to the Constitution of the People's Republic of China in 1988. This addition stated that the right to use land could be transferred according to the law. Although vague and easily overlooked in an era of economic reform, this line, supported by smaller-scale pilot tests conducted by the party, opened the floodgates. Unlike freehold countries such as the US, all land in China was owned by the state or collectives in rural areas. This was the case before the 1980s reforms and remains so today. However, the reforms allowed for the emergence of intermediaries. While the state still owned the land, it granted smaller local and municipal governments the right to use and develop the land as they saw fit. Local governments, eager to increase revenues for infrastructure projects or general operations, started selling these land use rights to property developers. These developers, in turn, built housing for a growing middle class in China, which now had the means to finance home purchases. Housing was no longer a begrudgingly invested need of the state but a lucrative opportunity. Local governments gained steady income streams through land sales. Private developers had a booming and expanding market to tap into, and increasingly affluent urban Chinese had more housing options and investment prospects. Suddenly, a private real estate and development sector, which had not existed a few years prior, became red hot. Urban living spaces expanded rapidly, as did home ownership. From 1998 to 2002, Chinese developers built enough housing to accommodate the entire population of the United States. In the midst of an economic miracle, the housing boom was inseparable from economic growth that fueled it, even though housing development did not directly align with economic growth. According to the rankings of the Sovereign Wealth Fund Institution, 6 out of the world's top 10 largest real estate companies, based on total assets, have their headquarters in mainland China or Hong Kong but primarily conduct business in mainland China. Furthermore, 4 of the world's largest land development companies were founded in the 1990s or later, experiencing meteoric rises from obscurity to becoming leaders in the construction industry. While part of this rise can be attributed to filling a significant supply gap, strategy also played a crucial role. Take the largest company, for instance. Evergrande's ascent began with a project that involved transforming a 110,000 square meter area, previously occupied by a pesticide plant in the Haizhu industrial district, into desirable apartments for the growing middle class. The project sold out within 2 hours, and the company promptly reinvested the earnings into 13 new projects across Guangzhou, propelling them toward the top. Other developers followed suit, erecting uniform high-rise buildings that seemed to replicate and multiply around burgeoning cities and industrial areas. To outsiders, it appeared as a boom, but for those within the industry, it felt more like a race. To keep up with competition, soaring demand, and seemingly boundless opportunities, Evergrande embraced a highly leveraged strategy. Like any property developer, they financed construction through upfront payments from buyers and borrowed money from banks and other financial institutions. They also ventured into non-housing sectors such as electric vehicles, theme parks, and even bottled water, diversifying their revenue streams. This aggressive expansion and diversification allowed Evergrande to become a conglomerate with interests in various industries. However, this strategy eventually led to their downfall. The cracks in Evergrande's business model began to show in 2018, when the Chinese government implemented stricter regulations on the real estate sector to control skyrocketing housing prices and prevent speculative bubbles. These regulations included restrictions on borrowing for developers, increased scrutiny on off-balance sheet financing, and limits on pre-sales of properties. Evergrande, heavily indebted and with a vast amount of unsold properties, started facing financial difficulties. As the company grappled with mounting debts, it resorted to desperate measures to raise funds. It offered high-yield investment products to individual investors, promising returns of up to 13.5%. Evergrande also started selling its own wealth management products, essentially borrowing from retail investors. These risky financial practices raised concerns among regulators and experts who warned of the potential risks and systemic implications. In 2021, Evergrande's financial crisis reached a tipping point. The company struggled to make interest payments on its debts, leading to credit rating downgrades and a sharp decline in its stock price. Evergrande's liquidity crisis reverberated throughout the Chinese economy, raising fears of a potential contagion effect on the real estate market and financial system. To prevent a disorderly collapse and potential social unrest, the Chinese government stepped in to manage the crisis. They encouraged Evergrande to resolve its debt issues through negotiations with creditors and implemented measures to protect home buyers and stabilize the real estate market. The Evergrande crisis serves as a cautionary tale about the risks associated with rapid and debt-fueled expansion in the real estate sector. It highlights the challenges China faces in balancing economic growth with financial stability and the need for tighter regulations to prevent excessive speculation and unsustainable debt levels in the industry. But in the affluent world, institutional investors are increasingly involved in residential real estate. However, China takes this phenomenon to another level. In 2018, a staggering 87% of home buyers already owned another property, indicating that many were purchasing homes primarily as investments. This posed two major issues for the central government. Firstly, skyrocketing prices made it extremely difficult for anyone other than the wealthy to find affordable housing. This, in turn, had negative effects on labor supply, particularly in high-demand areas. Secondly, the rapid expansion of the housing market, coupled with high vacancy rates, revealed that property prices were vastly exceeding their actual value. These inflated prices were not driven by limited supply, but rather by the belief that prices would continue to rise. In essence, a housing bubble had formed, and the government needed to address it before it burst. To tackle the issue, the central government implemented 3 rules known as the Red Lines in August 2020. These rules aimed to curb financial risks in the property development sector. Firstly, developers were prohibited from having liabilities exceeding 70% of the value of their assets. Secondly, their debt couldn't exceed their equity. Lastly, developers were restricted from accumulating more short-term debt than their available cash. Even if developers adhered to these red lines, they could only grow their debt obligations by a maximum of 15% annually. Violating one or more red lines resulted in even stricter growth restrictions. These red lines were not merely theoretical threats. Evergrande, a prominent developer, had a debt-to-liability ratio of 81% and a cash-to-short-term debt ratio of 67%, violating 2 red lines. Their net debt-to-equity ratio was also dangerously close to crossing the 3rd red line. As a result, Evergrande faced difficulties in completing the millions of apartments they had sold. they lacked the funds to pay builders and suppliers, and the new restrictions prevented them from borrowing more. Consequently, their cash reserves dwindled, existing obligations remained, and launching new projects became nearly impossible. Furthermore, the Chinese market underwent significant changes. While the rest of the world gradually returned to normalcy after COVID-19 restrictions, China maintained stricter policies due to the use of less effective domestic vaccines. These policies, along with declining economic productivity, disproportionately impacted the overall economy and individuals' finances. Additionally, the pandemic led to a reversal in the migration of rural workers to cities. The high housing costs, coupled with reduced labor demand, prompted many to return to their hometowns. Lastly, China's demographic shift, characterized by declining birth rates, meant that the proportion of individuals in the home-buying age group was shrinking, even if the overall population remained steady. In summary, China's housing market had become a bubble, prompting the government to introduce red lines to prevent a catastrophic burst. However, these measures exposed the financial vulnerabilities of developers like Evergrande. Combined with the impact of the pandemic and changing demographics, the housing market faced significant challenges. Evergrande, one of China's largest property developers, faced significant challenges as it struggled to generate money through new projects and pay off its debts. In an attempt to find cash, the company explored various options, such as selling its stake in a soccer club and courting potential buyers for its divisions. However, these efforts were unsuccessful, and Evergrande's financial situation deteriorated. The situation reached a critical point in December 2021 when the company failed to make payments on its bonds. This default declaration by Fitch Ratings signaled to the financial world that lending money to Evergrande was risky. As a property developer heavily reliant on debt, default meant that Evergrande's ability to secure loans at competitive rates was compromised. Despite its size and importance to the Chinese economy, Evergrande did not receive a government bailout. Instead, it faced restructuring, asset shedding, and cost-cutting measures to salvage what was possible. However, the challenges faced by Evergrande were not unique to the company. Other Chinese property developers, including Country Garden, were also under significant pressure, with defaults and debt payment failures becoming widespread. The Chinese property sector's collapse was not unexpected, given its heavily leveraged and debt-driven nature. The sector's flaws were exposed as the economy faced slower growth and demographic shifts. The impact of the property sector's downturn was particularly significant for China's middle class, who had invested their savings and net worth in properties that may now never materialize. This loss of money created a significant void in the Chinese economy. The controlled demolition of the Chinese property sector presents a delicate situation for the central government. The implicit social contract, where individuals sacrifice personal liberties for economic prosperity, becomes strained when the promised prosperity falters. The government's ability to fulfill its end of the contract becomes a critical factor in maintaining social stability and avoiding discontent among the population.